Well, good morning. Thanks for those who have attended today. And I'll just go and let you have the risk warning on your screen, have a read through that. A reminder, this is general advice only. And I do like to try and make this interactive as possible. So if you have any questions, shoot them through on the platform and I'll endeavour to go and answer them for you. But as a reminder, it's going to be general advice only, and anyone who participates in that session is doing so at their own free will. And of course, any of the information you hear in this particular webinar is mine only and not of City Index or StoneX Group, who is our umbrella parent company. Well, not much to do. Here I am. It's Friday morning. It's glorious here in Adelaide. And it really feels like the markets are in a bit of a slumber. Of course, Thanksgiving overnight in the United States, and anyone in the States listening on, hope you're having a great time and digesting that turkey. It surely would be a pretty decent meal today. Usually I don't kick off saying we've learned some things in the week that's been, but if I'm being honest, I don't think we really have. We've just learned a continuation of the same patterns of what we've seen recently. And especially around the US economy, still looks to be pretty good, 2.8% seasonally adjusted annualized growth pace. Inflationary pressures, whilst they've come down quite a bit from what they were back a couple of years ago, they too are looking pretty sticky right now. And it really is at the point where we're still at a coin toss for what the Fed will go and do in December. And we're still only talking about a handful of hikes coming through, less than a handful now, over the course of the next year. So there hasn't really been a lot for markets to go and grasp onto. And just to complicate matters, of course, with the holidays in the States, volumes have been very, very low as well. So you've had this rangy kind of markets with really, really little volume. So it's hard to go and trust a lot of the price signals that we've seen. Of course, the big news really was at the start of the week, and that's where we had the biggest reaction. Scott Bessent, the US Treasury Secretary nominee. Donald Trump made that announcement about 11 a.m. in Sydney time on Saturday. I was sitting here doing a dollar-yen report. And of course, that has had a big impact. It's helped go and calm the horses a little bit when it comes to the outlook for the longer-term trajectory for the US budget deficit. For the moment, traders, investors and the like giving him the benefit of the doubt. But how much longer? Well, we'll have to go and find out. Let's go kick off on that note, because I want to go and see the one thing that really stood out to me as being important this week, particularly when it comes to long duration assets, when it comes to some FX pairs, was that we saw a pretty bullish and big breakout in US 10-year note futures. Let me just go and pull that up on your screen. You can see here. So just so you're aware, I've contract adjusted this particular chart. So what does that mean? It means that it's better representative of the price action here and now, because you can see here on the screen, you've got the contract rolls that go and take place every 3 months or so. And when you have a market where you've got a big expectation for a change of interest rates over a period of time, you get these big gaps in the chart. So adjusting it moves the prices around to give a better reflection as to where the flow is going through right now. Hopefully that makes sense. Anyway, the message doesn't change one iota. So I was talking about this last week. I wrote about it a couple of times as well. And I said, I don't see there's anything that's going to be a lot that could potentially go and lead to a breakout, a bullish breakout of 10-year note futures. And then, of course, Scott Bessent's nomination came along. Markets just rejoiced at it. And then look at the reaction that we saw here. Big bullish breakout. You can see here 1, 2, 3, 4, 5, 5.5 attempts to go and break through. Then eventually, boom, up we went. And you can see on the back as well of record trading volumes going through. Now that was related to the roll of contract. It wasn't just Scott Bessent and the markets getting really enthusiastic about that, but it was a contributing factor. And you can see after the breakout, we've had a bit of a consolidation period and then a bullish engulfing candle and then another one on back of that when it comes to a bullish candle. Volumes, as you'd expect around Thanksgiving, have been paltry, so you've got to put a little asterisk next to the actual outcome there. But still, it's a pretty strong signal, especially given the flow that was going through earlier in the week. We also saw that when it came to 2, 5 and 7-year Treasury note auctions that were conducted during the week, they were all met with very, very strong demand. So all the hyperbole about how everyone's fearful about the US budget deficit, Trump's going to go and make it balloon to things we've never seen before. Well, that might be the case. But right now, demand is very strong for treasuries, particularly after the move higher in yields that we've seen recently. And just remember, when it comes to looking at this, this is the price, so futures price. So the direction that it moves, the opposite direction, is what will happen with yields. So as it's gone and broken bullish breakout, it means that yields have pulled backwards. You can see here, I don't think I've got it on my screen right now. Actually, here we go. So you can see, just to go through them. So 2-year yields here on the left-hand pane, 10-year yields on the right-hand pane, and then 30-year yields on the other right-hand side here. And just looking at the other rate of change here, what we're looking at is basically the move over the past fortnight. So you can see 30 years down about 19 basis points, 10 years down 19 basis points, only about 8, so less than half when it comes to 2-year yields. And that really reflects the Fed outlook and the fact that markets are still contemplating the Fed is going to not have to go and cut very aggressively moving forward. But you can see here, at the moment, the bullish breakout in futures tells me that in the near term, risks of a yield starting to go and jackknife higher have probably gone and receded for the time being when it comes to that really key benchmark 10-year yield. So you can see here that what we're seeing is that there's been a bull flattening of the curve, and that is the Scott-Besant factor is one of the things there. The other is the fact that the Fed is getting pretty aggressive when it comes to the outlook for interest rate cuts. Just to go and show that, I'll go and pull this up here. ZQX 2024 minus ZQZ 2025. So what I'm doing here, the codes, you can be plugging in. Right now, basically, it's looking at the shape of the Fed funds futures curve between now out to the end of next year. And it gives you a rough kind of guide as to what markets are expecting in terms of the magnitude of rate cuts expected from the Fed. Negative 0.80. So right now, that translates to about 3 cuts are being priced between now and out to the end of 2025. And when it comes to the December meeting, at this stage, there's around about probably a 60, maybe a little bit higher, 66%, 63% chance or so that we might go and see the Fed cut. So it's still favored at this point in time, but it's really going to come down to the data flow next week as to how it will proceed. And I'll go and have a touch upon that in just a moment. So remember what we got off to the start about what was happening with Treasury futures and the fact that they're gone and ticked higher. Then what that points, yields have come lower. And that's really important when it comes to some FX pairs in particular. So what we've got here, US dollar index daily chart. We've just got in the middle pane here, 2-year yields in black. We've got 5-year yields, 2-year yields in blue, 5-year yields in black, and you can see red 10-year yields here. And you can see that they're all rolled over. And then you look at the correlation analysis over the past month. So this is a 20-day rolling correlation. Now, you can see here that it's weakened a little bit when it comes to 2-year yields. And the further out the curve you go, out to 10 years, you can see here the really strong positive correlation that the DXY had with interest rates has started to go and subside a little bit at the moment. Now, it's still pretty strong when it comes to Fed rate cut expectations up the top here in yellow. So what the Fed pricing is doing is being pretty influential still on the DXY. But the further out you go, the less impactful it's been when it comes to movements in the dollar. And so that's really interesting because what's happened over the last week or so in particular, to go and explain this weakening that we've seen, is that there's been more of a shift in focus to relative performance and relative economic data in other nations, where up until recently, it was almost unilaterally about what was going on in the US economy. But right now, it looks like there's been a bit of a tilt back to what is the implications for other economies around the world. And just to go and underline that point, so have a look at the 10-year correlation here between the US dollar index, DXY, 10-year yields sitting at 0.4. Look what happens when I go and do the spread between US 10-year yields and German 10-year yields. So this is with the DXY, you can see here, it's sitting at 0.93. So we know that the euro is the biggest constituent in the US dollar index. So what's happening with spreads, it's between the US and Germany, is being very influential, not only on euro dollar, but the US dollar. So we're seeing that across the board. It's not just Europe, but especially Europe, especially the UK as well. Spreads, 10-year spreads between the US, Germany, US, UK, and even the likes of the Japanese yen, 10-year JGB yields less US 10-year yields, they all are now starting to go and be influenced by spreads, not outright US yields. So hopefully that makes sense to you. So we need to start paying attention not just to the US calendar coming up, but also other events outside of the United States, because it is having an influence clearly on some of the moves that we're seeing in these pairs. So with that in mind, I think it's probably best to go and have a quick look at what's coming up next week. And there's a lot. It's the start of a new month, and that means that there's a whole plethora of information that comes through. So what I've got here, I've narrowed it down. So it's G20 nations only, so the biggest economies in the world, and it's the market events deemed by TradingView, who puts this together, that are the most market moving. It's not to go and suggest every single one is going to be market moving, but these are the ones that go and keep a bit of a closer eye on. I'll be brutally honest with the ones that I think are going to go and move markets and the ones that probably can go and let go, because I'm not in the interest in the slightest of trying to go and create unnecessary noise that can just go and confuse the messaging that you need to be concentrating on when it comes to assessing potential setups. Kaiji manufacturing PMI, we'll get the official PMIs from China out over the weekend. No, I don't think there's going to be much of a reaction at all, to be honest, unless there's clear evidence that we've seen a very strong rebound or the fact that there's no rebound at all. Markets are expecting the information to go and show a continued improvement, modest improvement, given what's been pushed through when it comes to some of those stimulus measures and the like. I'm far more interested in the US calendar still. ISM manufacturing still gets a lot of attention, even though the manufacturing sector is only around about 10% or so of the US economy. So that's one to keep an eye on Tuesday. Actually, these are all times as well for Sydney, Australian Eastern Daylight Time. Then we start getting into some of the more important ones. So job openings on Tuesday evening in Asia, Wednesday morning, very early for us here in Australia. JOLTS job openings, very volatile series, but we know forward leading indicators on the US labour market are being still very, very closely scrutinised by the Fed. Hence, the markets are going to go and react probably to what we see there. We saw a surprise bounce, I think, coming through last month, so watch for a potential revision back down lower, because the trend has been lower, apart from what we saw a little blip last month. The Australian GDP growth report, a lot of headlines. It'll be a more equal standpoint. We have an election up here in Australia, obviously, in the next 3 or 4 months. But I've lost count as to how many times I've seen a GDP report come out and there's been almost no market reaction. So I don't think we're going to go and see any real meaningful move from that one. ISM Services PMI, Wednesday evening in Asia, very early Thursday morning our time here in Sydney. That's a big one. Biggest part of the US economy. It's a soft survey, but what does the participants, what do the survey respondents think now that Donald Trump has been confirmed as the next president of the United States and has control of Congress? It's already been come back to go and kind of meet what we've seen with other services PMIs from S&P Global. But if we get a really, really strong report there, it's just going to fuel that kind of market belief right now that the Fed is not going to go and have to go and cut aggressively over the next year or so. Jerome Powell speaking. This might be in front of a Congress as a scheduled thing. But just the unfortunate timing of this is that it comes a day before the non-farm payrolls report. So out of everything on your screen right now, non-farm payrolls in the United States is by far the most important data release globally next week. You cannot avoid that. Unfortunately, it's not at a great time for us here in Asia, unless you're a night owl and don't have much of a social life on a Friday evening or Saturday morning, depending if you're having a big one in Australia. But you can see it's going to be big. Going back to what we saw last night, we saw some jobless claims data come out. And whilst the initial jobless claims figures were very, very low, which is a sign that there's not a lot of new claimants coming through the other pipeline when it comes to those seeking unemployment assistance. When you go and look at what the continuing claims measure was, that's still sitting at multi-month highs, and it's been moving ever so higher. And the translation of that across is that last week was the week is the reference report for the payrolls figures that are going to come out next Friday. And so when you look at the detail there, the fact that unemployment people who have been sitting on continuing claims have been unemployed for a while, that potentially he could go and put an upside risk here. And after the figures have come out on Wednesday, there was a bit of a move when it came to the pricing for the December Fed meeting. It went from almost 50-50 to over 60-40 in favour of a 25 basis point cut. So markets are very aware of that. But remember, that's now probably being factored in to market thinking. So at the moment, 4.1% unemployment rate is expected. So unchanged again, remembering that the Fed was looking for 4.3% by the end of the year. So it's still undershooting that by quite some distance. 183,000 increase in payrolls. People don't like it. It's not shown on the screen here, but the ADP National Employment Report that comes out 2 nights earlier for us here, that's going to give you a as to what we'll see when it comes to payroll. Kind of in line with expectations. One to go and keep an eye on right now. So to me, the payrolls report is going to be the unemployment rate in particular to go and pay attention to. That's what the Fed is graded on. If there's a market reaction when it comes to payrolls, then of course that will be something to go and potentially look to fade. But I'll go into that more detail next week because of course we do have another one coming through on Friday. Let's get straight into the markets. Let's kick off with some equity stuff, shall we? Because yeah, it's some pretty interesting moves. Lots of markets at or close to record highs right now. So I might as well go and have a look. Let's kick off here in Australia. I put a tweet out yesterday, probably ominously, probably a lot of the bears would have loved it. I said that shorting the ASX 200 SPY future should come with a health warning, and yeah, lo and behold, that pretty much was the top. But it still remains in a very, very strong uptrend. Every time we've seen pullbacks, we keep seeing the price bought. And when you go and look at some of the moves here, you can see here, higher lows, higher lows. So for the time being, it's a buy on dips play. There's signs at the moment that when you go and look at what's going on when it comes to RSI 14, well, it's starting to diverge a little bit from prices. That's a warning sign that we might go and see a pullback to this uptrend potentially, or even maybe 8310 where the price has done some work in the past. But I wouldn't be thinking anything more than that. We are coming into a very strong seasonal period for the markets. And yes, the banking sector in particular is looking very bloated from a valuation perspective, but it's looking okay. Nikkei is another one I've been paying close attention to. The correlation between it and dollar yen has broken down quite a lot recently, so it's not that kind of easier sort of guide to go and trade, but have a look at this. So you've got sitting in a triangle, that's the first thing. But have a look, 38,000. 1, 2, 3, 4, 5, 6, 7. That's a lot of movements that we've seen coming through recently. So you can see at the moment, there's just people just nibbling away every time we see a dip below 38,000. We're not far from that level again today. Even though, when you look at what's going on when it comes to the momentum, RSI 14 is still ever so slightly grinding lower. We still have a bearish signal when it comes to MACD. At the moment, there's clearly some two-way flow coming through. And look, you can see over the course of the recent weeks, below 38,000 has been a pretty decent buying level. So keep that in mind if that's something that's on your radar this week. Let's have a look at what's going on in the United States. Here we go. Come on. Come on. I know it's Friday. Look, very, very weak volumes, granted, but the technical picture is looking a little bit less bullish now. You can see here, uptrend that was in place, tried to go and bounce off today though. It's now gone and fallen beneath that uptrend. Volume's weak, but not willing to go and take out the former record highs. So right now, just looking at what's going on, potentially when it comes to some of the momentum indicators, it looks like right now that either sideways or maybe we're going to see a revisit back towards this 585,475, the low that we saw back earlier this month, and also the 50-day moving average, which on occasions, as you can see back here, has actually acted as support. So that to me is the kind of extent of the move you'd see if we go and see a pullback from here. If the price was to go and reverse back and close above the former record highs, then of course it's back to the race again and positioning for some further upside. But at this point in time, it's looking a little bit heavier. Small caps. Russell 2000. For a long, long period of time, it was a play on how big a scale of Fed rate cuts were going to be delivered. But that's changed around now. It's very much the Trump trade, a signature Trump trade. And you can see at the moment, it ever so briefly when it comes to futures for the Russell, when it broke the record highs, but then it really has just been struggling again to go on with the move. So again, a bit of apprehension around those record highs. Not really a great sign. And if you are still feeling bullish, you still want to go and buy dips, which at the moment, now looking at some of the other details here in the price action, is the way that I'll play it as well. Don't force the trade unless you feel really compelled to go and do so. Wait for a really clear, obvious sign. But right now, we've seen failure above the former record highs, another attempted failure, and then you can see here, again, we're having another look, but on the back of absolutely nothing volumes. If we see a clear definitive break above this level, by all means, the risk reward does favour going long with a stop beneath this 2460.8, which is the record high that was set back earlier this year before breached earlier in the week. I haven't been looking a lot at crude recently, I've got to be honest with you. Let's have a look at Bitcoin. No, actually, let's have a look at Bitcoin. Let's go and have a look at some of the FX markets. Aussie dollar. Consolidating sideways range, you can see here, momentum indicators, RSI 14 is trending higher, MACD is giving a positive signal. So right now, it looks like to me that we may have seen the bottom earlier this week, but that was based on Trump's tirade, latest tweet storm or Truth Social storm about the looming tariffs that were coming through. But that was very briefly lived. At the moment, sideways range, 6546 on the top side, 6441 on the downside. It's pretty definitive, play the range, but to me, it looks like the risk may be starting to go and skew a little bit to the upside. Kiwi. The RBNZ, I was looking for a 75 this week. Got it wrong, not for the first time, but they were a little bit hawkish, which I found really surprising considering the Kiwi economy looks like it's in recession and needs a lot more support, but I got it wrong. But you can see here that, no, it's broken its downtrend straight through, and then it's consolidated the move. Right now, 5912, you can see the price bounce, eventually through, back test. So that near term is the level to go and focus on. If it can't break through that, look to go and short again. If we see a close and break above it, then potentially you can see some upside open up towards the low 60-cent level. You can see here both the 200-day moving average and the 50-day moving average, and you can see here as well at 6053, the price action over either side of that suggests that's a level to keep on the radar. But like the Aussie, you can see here breaking the downtrend. We've got MACD that's turned higher. That's pretty positive. So it looks a lot better than what we saw only a couple of days ago. Euro, on Friday, we saw this flash PMIs came out from France and Germany, and they were just utterly putrid. And it looked like capitulation, utter annihilation of those who were clinging on for longs. And the number of tweets that I saw coming out at the time on social media and the like told me that maybe we're coming close to a near-term bottom, and then that actually proved to be it. So 103.33 is the level that it bottomed out at, multi-year lows. And since then, it's gone and had a corrective bounce, but it can't go and bust through 106. So to me, that's the near-term level to go and focus on. Again, like the Kiwi, if it can't go and break through that level, then you could go and look to go and set shorts, stop above, targeting a flush back down towards those former lows. Alternatively, if we get a break and close above it, what you could do is go and buy, set a stop beneath. First 106.66, a bit ominous there, but that's just a very, very minor level. You can see that dates back to a low that was set in June this year. And then above that, there's not really a lot to go and speak of until we get back to 108 or so. Looking at momentum, whilst MACD is still flicked higher, already there's signs that momentum is starting to wane. Euro, to me, still looms as a sell on rallies prospect until you get some definitive signs that the US economy, the exceptionalism that's been powering it along, has not really come to fruition. Really quickly, dollar yen. It's been a consequence of that bullish breakout in bond futures I kicked off with. You can see here the same day that it went and broke those bond futures higher, it went and broke lower. It's really still quite a strong play on US 10-year Treasury yields. And you can see at the moment, after breaking through, it's done away with 103.38, Then also the 200-day moving average. And then you can see here, that's now kind of looks like maybe we're trying to go and just consolidate the move right now between the 50 and 200-day moving averages. 105.90 is another level that the pair has done a lot of work either side of over the course of this year and late 2023. So that's kind of the zone to keep an eye on right now. Which direction the price breaks from this area will be quite instructive. Given we've just seen some flash Tokyo CPI data that's come out for November, which was a little bit stronger than expected, it really fits with the idea that the BOJ is likely to go and hike rates again, even though the dollar yen is really not that interested in Japanese developments outside of very, very modest moments in time. Whenever you see something about the BOJ, there seems to be a big market reaction. More broadly, the correlation suggests that it's not the key driver. But on occasions, especially in Asian time zone, if there's any headline suggesting the BOJ is going to go and hike and maybe get a little bit more aggressive than what markets are anticipating, watch for a big move potentially to the downside. We haven't seen that yet, but certainly the data that came out today does increase the likelihood that the BOJ will go again next month, just before Christmas. Really quickly, I just want to go and finish off with what's going on in the gold price. Big flush, big bearish engulfing candle that came through last week. And then this week we've just been consolidating. You can see this uptrend was broken. And I thought, I might just go and just get rid of it. But it actually, you can see here that whilst it broke through, spent some time below it and then came back, it looks like it's a false break at this point in time. You can see here already bounced off it again. So keep that in mind when it comes to the details here. I haven't updated the RSI or anything like that, but you can see here, it's now trending lower. You can see MACD as well has also crossed over. So momentum indicators right now suggest that it's reverting to a sell and rallies play. Let's see what happens around this 50-day moving average, which you can see over time has been very respected by the market. So that to me, this uptrend, 50-day moving average, that's the zone to keep an eye on near term. If we see a move either side of that and a clear break, that will be the way to go and play. But for the time being, I still don't mind gold. Yes, we've got a peace accord between in the Middle East. We also go and have some more clarity, at least on this speculation that potentially we'll have less concern about US fiscal position moving forward. So that's taken that risk premium out of it a little bit. But still, when you look at what's going on in the world when it comes to monetary supply and the path of interest rates and debt levels, yeah, gold still looks pretty decent for me. Look, we've been going for nearly half an hour. I thought this would probably be about 15 minutes, so we might go and wrap it up. I haven't seen any questions come through, so I presume that I've covered everything you need to go know about. If you do have a question afterwards, shoot it through to me on X. I'm pretty active on there, sitting here in my little home office. Otherwise, have a fantastic weekend. Enjoy your rest, and then we'll get ready to go and do it all again at the start of December. I'll catch you next time.